Hello everybody, my name is Ash Nandra Jog and today we are going to look at exercise 1-8 from page 8 of the workbook from chapter 1 for accounting 1030. So before we look at the problem, I would like to revisit the accounting equation. So the accounting equation as we know it is assets equals liability plus owner's equity. So think of this as a weighing scale. On the weighing scale, on the left side, you have all the assets. And then you have on the right side, the liabilities plus the owner's equity. So in assets, we could have cash, we could have supplies, we could have the land, stuff like that, which is a part of the assets. And the liabilities, we could have accounts payable, and then the capital is part of the owner's equity. So what we need to remember is whenever we do a transaction in accounting, the left side has to balance the right side. Okay, so that's important to know. Now let's look at our question. So our question says, Gael Hayashi, MD, opens a medical clinic. During her first month of operation, January, the clinic entitled Hayashi Medical Clinic experienced the following events. So they have given us a series of events which we have to analyze, and we have to write them in the accounting equation and see how those events will affect the elements of the accounting equation. So before we look at the events, let's look at the worksheet. So we've been given a worksheet on which we have been given the date column. Then we've been given the assets equals liability plus owner's equity. So in the assets, as we just saw, we have cash, medical supplies, and land. On the liability side, we have accounts payable, which is money we owe to our suppliers, plus the capital investment from the owner, which is part of the owner's equity. And then we have some accounts which are part of the income statement, which is something you would learn later in the course. But this is part of owner's equity. So the service revenue is the business which the business generates. And as you can see, it adds to the owner's equity. So the more revenue you make, or the business makes, the higher will be the eventual owner's equity. But then there's the expenses which will decrease the owner's equity. So the higher, and that's why there's a negative sign here. So the higher the expenses, the lower will be the ending owner's equity. Okay, so then similarly we have the salaries expense and we have utilities expense. So remember that when we are making the transactions, eventually the assets would have to equal a total of liabilities plus owner's equity. Okay, now let's look at the transactions. So January 6th, Hayashi invested 250,000 in the clinic by opening a bank account in the name of Hayashi Medical Clinic. So the owner Hayashi has invested 250,000 in the clinic. That means that the business, which is the clinic, has received 250,000 in cash from the owner. So we know our cash has gone up. We have to now understand what will be the corresponding entry on the right side of the weighing scale. And that will be the capital account, because the capital identifies the amount of money at stake from the owner. So if we go back to our equation now, let's write the transactions. So January 6th, we have increase of 250,000 in cash, and corresponding entry is the capital increase of 250,000 from the owner. So we can now write the balance. So balance is 250,000 in cash. There is no supplies yet, no land yet, no accounts payable yet, and only the capital of 250,000. And remember the weighing scale, the left side equals the right side. Okay. Okay, now let's look at what is the next transaction. So on January 9th, Hayashi Medical Clinic paid cash for land costing $150,000. There are plans to build a clinic on the land. Until then, the business will rent an office. So let's analyze this statement. So the clinic has paid cash for land. So what this means is that we have used the cash to purchase land for the business. So one form of asset, which is the cash, is changing into another form of the asset, meaning one form of asset is decreasing and the other is increasing, but the net effect on the asset side is zero. Okay, so therefore there would be no entry required on the right side. So only cash is going down and land is going up. So net effect on this side is zero. It's like picking a weight from here and putting the weight here. So that's why we don't need to put any entry on the accounts payable side or the capital side. Okay, so let's go back to our equation now and let's write down the transaction. So January 9th, remember we have lowered the cash because we have spent the cash, 150,000, and we have bought the land for that amount. So now we own land for 150,000. There's no change to accounts payable and no change to the capital. So the total capital remains the same. All right, again, we can write the balance. And now our cash on hand is 100,000 and the land is 150,000 and the total capital is worth 250,000. So the left side, all the assets is 250,000 and the right side is the capital 250,000. So our weighing scale is still balanced. All right, now what happens? Let's read the next transaction. On January 12th, the clinic purchased medical supplies for $10,000 on account. Okay, so we are saying we have purchased medical supplies, which are supplies, which is part of the assets, for $10,000. That means one of our assets is going up. But on account means we haven't paid cash for it. We have bought them on credit from our supplier on account, which means our accounts payable would increase by $10,000. So let's try to put this transaction here now. So on January 12th, there's no change to cash. We did not pay cash. We got $10,000 of supplies. There's no change to the land. We have $10,000 of accounts payable because this is money we will eventually have to pay to the people who have supplied, or the business which has supplied us the supplies. We haven't made any revenue, there's no expenses yet. Okay, now we can write down the balance. So we write the balance here. So the balance now is still 100,000 for cash. We now have $10,000 of supplies. We have 150,000 of land. We owe $10,000 in accounts payable, and the total capital is 250,000. Okay, you will notice that the equation would still balance. Okay, let's move on. Look at the next transaction. On January 15th, Hayashi Medical Clinic officially opened for business. Okay, so in this statement, there isn't any thing to record. It's just they have officially opened for business. There is nothing, no change to assets, no change to any revenue, nothing like that for this transaction. Now let's look at what happens between, let's read the Req Start Statement. It says, during the rest of the month, the clinic earned professional fees of $20,000 and received cash immediately. Okay, so the next statement says, during the rest of the month, the clinic earned professional fees of $20,000 and received cash immediately. So the business has earned professional service fee, which is the revenue, and for that they have received cash immediately. So for that, we would record something on the cash side, which is our cash is increasing by 20,000, and the same amount of $20,000 we will recognize as service revenue. So let's make that entry in our worksheet. So we'll say January 15th to 31st, we received cash for $20,000. Sorry, wait a second. Cash for $20,000 increased. No change to supplies, nothing. But we recognize the service revenue, which is the right side of the equation. So now our equation still balances. We can write down the balance again. Now we have total of $120,000 in cash, and we have $10,000 in supplies. We have $150,000 of land, and the accounts payable is $10,000, and the capital is $250,000. And now the service revenue is recognized as $20,000. Okay. Now let's read the next transaction. The clinic paid cash expenses, employee salaries. So these are the cash expenses. We paid these expenses by cash. We paid employee salaries for $5,000, office rent $4,000, and utilities $500. So now we would make that entry. So obviously our cash is going down, and we are recognizing the expenses on the right side. All right. So again, January 15th, between January 15th to January 31st, our cash went down. Let's recognize the first one is $5,000. So it went down by $5,000. And that was for the rent. Okay, so we will recognize the rent expense. So we would say rent expense $5,000. Now, why am I putting it as a positive sign? Remember, we're putting it positive because we are going to subtract it from the revenue to get the net income. So therefore, because this is being subtracted here, I don't have to put a negative sign. So this is recognized as a positive, but it will be subtracted. So it will eventually decrease the owner's equity. Okay. So this is why it's like take away 5,000 here and take away 5,000 here. So that's why our equation would still balance. All right. Now, again, we can write down the balance. So if we go back to our worksheet, balance, what do we have now? We have 115,000. Actually, let's write down all the transactions together, and then we can write down the balance. So 5,000, now subtract $4,000, because now we are paying for the salaries, $4,000. Okay, and then we have $500, negative $500 for utilities expense. So we will recognize utilities expense for $500. And now we can write down the balance after all of those expenses. So now we are left with a total of $110,000 and $500. $110,500 is our balance in cash. Medical supplies still remain unchanged. The land remains unchanged. The accounts payable remains unchanged. The capital remains unchanged. The revenue, we haven't earned anything new. And now we have recognized the rent expense is total $5,000. Salaries expense is total $4,000, and utilities expense is total $500. Okay. Now let's read what is the next statement. On January 28th, the clinic sold supplies to another clinic at cost for $1,000. Now this is not normal. This is just a one-off situation in this business. They are not in the business of selling supplies. They are in the business of offering medical services, but they happen to, it's like, they may have another clinic and they just transferred or sold some supplies to another clinic at cost. So we're not going to recognize this as a sales revenue. We didn't sell anything it was not recognized as a revenue for us. This is just, we got cash for supplies. So in this situation, our cash is increasing by $1,000, and our supplies are going down by $1,000. Again, one form of asset is being transformed into another form of asset. So in our equation, we would write it as January 28th. Our cash went up by $1,000 and supplies went down by $1,000. So net, there is no change to other assets or liabilities or equity, and will remain everything same. So now we can write down the balance, and we should now have a total of 111,500, and medical supplies would be 9,000, and we went down by 1,000. So land is 150,000, 10,000 is the accounts payable, capital is still 250,000, service revenue is still 20,000, and rent expense is 5,000, and 4,000 is the salaries expense, and utilities expense is 500. All right. Now let's look at what happens next. So then it says in our question, the clinic paid $4,000 on the account from January 12th. So remember, on January 12th, the clinic had purchased medical supplies from the supplier on account. That means we were supposed to pay this supplier $10,000. So on January 31st, we are paying them $4,000. Okay, so that means our liability or the accounts payable would go down by $4,000. And how do we pay somebody? With cash, right? That's how we pay somebody. So our cash would have to go down by $4,000, and then the accounts payable liability would have to go down by $4,000. So let's record this transaction in our workbook. Okay, so January 31st, we would say our cash has to go down by $4,000. So we record $4,000 negative. No change to supplies. We are saying accounts payable has to go down by $4,000. Okay, so that will leave us with a balance on the cash. It is 107,500. We now have $9,000 in supplies. We have land of 150,000. We have our liability is the money we owe to our suppliers, only 6,000 now instead of 10,000 before. The capital is 250,000. We have 20,000 in service revenue, which we earned for the month. And rent expense was 5,000, and salaries expense was 4,000, and utilities expense is 500. Now, if we added all the assets, that will be total of cash plus the medical supplies plus the land. What we get is 266,500. Okay, what about stuff on the right side? So let's just make a cell here. Where do we have that? Option, merge and center. So we would just add up all the liabilities and the capital. So we would say equals the accounts payable, which is liability, plus the capital, which is the owner's equity, and plus the service revenue. Okay, and then minus the rent expense, and then minus the salary expense, and minus the utilities expense. What do we get? 266,500. Okay, so you can see that the total assets is equal to total of liabilities plus owner's equity.